Hello economics students, this is the last video on low and stable inflation. We're going to finish this video like we've done with the other two goals, looking at the consequences of not achieving the goal and the effects on living standards. This is quite a big dot point, so I'm going to probably split it into two videos. This first one is just going to be when inflation is too high. What are the consequences of inflation being too high? And the first one is the erosion of purchasing power. Now, erosion is just when things sort of disappear or decrease. I always think about like the erosion of soil, like when water hits soil too much, it erodes, it disappears. In this case, we're looking at the erosion of purchasing power. And the purchasing power really just measures what a given amount of dollars is able to afford. So what $1 can afford in an economy. So a decrease or an erosion of purchasing power would mean that you can afford less with the same amount of money. So why is this a problem? Well, if inflation rises fast, like for example at the moment when it's rising at 7%, inflation's at 7%, and the amazing AAU negotiated teachers a pay rise of 2%. So if inflation is rising at 7%, but wages are only growing at 2%, that means that teachers' purchasing power is being eroded or decreasing by 5%. In other words, teachers' living standards, their material living standards, are decreasing by 5% each year. So this is bad for living standards. It's happening to lots of industries, not just teachers. The second one is the development of a wage price spiral. And this is something that the RBA is worried about. But as far as I'm concerned, it's purely a theoretical idea because we haven't seen it occur for a very long time. But let's think about it theoretically, and the language here can help us. A wage price spiral. We'll start out with wages. Let's imagine that some industries, some employees have bargaining power and they're actually able to negotiate an increase in wages in line with inflation. So let's say they get a 10% increase in their wages. The idea of the wage price spiral would be that then businesses have to increase their prices by 10% to account for the increase in costs of production. So it would cause cost inflation. Then it starts to spiral. Those employees go back and say, well, inflation has gone up again, so we deserve another pay rise. And if businesses give it to them, then they have to increase their prices again. And then the whole thing kind of spirals out of control. And we get entrenched inflation, like inflation that's very hard to fix. We could also think about it from the demand side, like if you get a pay rise above inflation, you're going to spend more into the economy, so there's some demand inflation as well. The idea would be that this sort of gets out of control and it spirals. Obviously, that's bad for living standards, particularly for everyone else in the economy who doesn't have bargaining power and who just has to deal with the erosion of their purchasing power. There's also a distortion of investment and spending decisions. In times of high inflation, people do funny things with their money. And if you wanted to look at some really interesting examples, have a look at Venezuela and I think it's Argentina. There's some really interesting examples of really high and entrenched inflation. You could do a whole course on it. But people do funny things with their money. Traditionally, in times of inflation, investors would put money into things like gold and precious metals and art to try and maintain their purchasing power. They're trying to make sure that they're not going to fall victim to that erosion of purchasing power. But more recently, people are investing in silly things like NFTs and maybe Bitcoin. I think this little image here sold for $8 million, all with the intention of avoiding the high inflation or avoiding the erosion of purchasing power. Of course, this is a bad allocation of resources, an inefficient allocation of resources, and so we would say it would decrease living standards. There's also a lower return on investment. Now, this one I would definitely say go and do some reading in your study guide or in your textbook. There's lower returns on investment for a couple of reasons. The easiest one to understand is, let's imagine we have investment that returns 3%. Our investment returns 3%. Maybe it's a bond or maybe it's shares or whatever. And then inflation is at 7%. Well, to understand the lower returns on investment, if inflation is 7%, you're only returning 3% on investment, a bit like teachers with their wages, you're actually receiving a negative real rate of return. So the real rate of return after accounting for inflation is actually negative 4%. So that's one way to think of lower returns on investment. There's some other ways to think about it where we bring in the RBA and their decisions with the interest rates, but for now I'm just going to leave it there in the interest of time. Another one is the loss of international competitiveness. We haven't talked about what international competitiveness means yet, but it's the ability of Australian businesses to compete in world markets with other businesses, right? So maybe it's the mining industry, maybe it's the financial services industry in Australia. Now, if we have really high inflation in Australia and the rest of the world doesn't, well, we become less competitive. Our businesses are less competitive in global markets because the price of our goods is higher than other countries. And therefore, we sell less, and that's bad for living standards, right? Less jobs, less economic growth. All right, I might keep going here because I'm almost done. If inflation is low, which has been a problem, it's been a problem in the past. It's been a problem for probably like up until 1 or 2 years ago. It's been a big problem the RBA has been concerned with, that inflation is too low, or even if inflation is, or if there's deflation, if inflation's going backwards, prices are going backwards. And that's a problem too, because what happens is it's kind of like a reverse spiral. Instead of spending money, consumers delay consumption. They actually think if that fridge is going to be cheaper in the next 6 months or the next 12 months, they don't buy things now. And that slows down the economy. And that's really bad for living standards. It also means that there's less jobs because if the economy is slowing down, there's less demand for labor, and higher unemployment is bad for living standards too. All right, so those are all the consequences of not achieving the goal of low and stable inflation. It's a lot jammed into one quick video, and I feel like I'm talking at 1,000,000 miles an hour, but make sure you go back and have a read of your textbook or your study guide to truly understand these. Bye for now.